For people who are business owners, the employer community, the two most common things that we see in terms of how businesses are set up are limited liability corporations, LLCs, or S corporations. The other one that you see a lot is C corporations. C corporations tend to be your larger companies, and that's just because of how the federal tax code works. For LLCs and S corporations, the money that you make as a business, that shows up on your tax return as personal income. You then get taxed at the federal level based on your distributions to yourself. So, hey, I'm a business, and last year we had $10 million in sales, we had $500,000 in profit. Me as the business owner, I'm showing $500,000 in profit, but I'm only going to take a distribution to myself for my own income of, say, 100 or 150,000. I'm going to take that 450,000 or $350,000 left over, and I'm going to use that to buy a new roof for my shop. I'm going to use it to buy a new semi truck. I'm going to use it to buy a new CNC machine. I'm going to use that for, new conveyor belts, whatever it is. And so that revenue goes back into the business, and you're not taxed on that. The way that this tax system would work is that you would be taxed on the full amount, anything in excess of $1 million. So that same exact example, except instead of making $10 million you have $500,000 in profits. Say you made $40 million in sales, which sounds like a huge number for a lot of people, like, oh my gosh, $40 million, that's so much. I was talking to a gentleman the other day. He has 5 coffee stands, like coffee stand in like a gas station parking lot. He's grossing well over $1 million, annually. These are not, huge moguls that we're talking about. These are oftentimes mom and pop shops that are going to be in excess of $1 million. And basically, we're taxing people on the money that they would have set aside to reinvest in their business. So this is not money that they distributed to themselves, not money that they're spending themselves. Money inside a business is not money that can be spent personally. Like, you get in all kinds of trouble with the IRS if you do that. So this is funds that these people do not have at their disposal that they are being taxed on, which really means it's not a tax on them, it's a tax on the business.